Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in TradFi, digital assets, technology, and financial planning. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq market site is David Berdon, Managing Director at Morgan Stanley Private Wealth Management, Michael Tanney, Senior Managing Director at Magnus Financial, Michael Durso, Founding Partner, CEO, and CIO of ShoreHaven Wealth Partners, and George Zaki, Executive Vice President at Janney. They join me to discuss how the financial planning space is evolving in response to changing client needs, market conditions, and technology innovations. It is great to have all of you with us. Welcome to Trade Talks. And David, we'll kick it off with you. It seems to be that the advisor industry is evolving in a way where it's not like I call you, I do the work. It is getting more complex.
It really is. Look, if you go back 20 years or so, this was relatively straightforward. You pick up the phone, you call a client, you sell them a stock or bond, you're done. Today, think about the things an advisor needs to be proficient at. We need to be good at bringing in business, good at managing relationships, proficient at global investing. It's not just stocks and bonds now, it's global, it's alternatives. And then financial planning, tax and estate law. There's so much to know. All of these topics require different skill sets. It's impossible for one person to be good at all of that. I think this speaks to the importance of scale and the importance of teaming, of being on a big team where you can do all of this and have division of labor.
Yeah, and Michael, I also think it's interesting where you're seeing the RIA model move to its independence as well, so that you have the ability to be more flexible with different types of products?
Absolutely. You can tap into the intellectual capital of the whole universe, right? We can decide to work with a specific firm that offers a specific product or a specific accounting firm. We have the ability to just maneuver what's best for the client. And when you think about it from the fiduciary angle, it's so easy to understand the value add, right? When we're talking to a client, we're not selling them anything. We're helping them. And that fundamental difference in the responsibility of your core responsibility of what you're doing just makes everything so much easier, because now the client's asking the right questions. They understand the motive of why we're suggesting something. And to Michael's point, the complexity is only getting wider and stronger, and that's also talking to the competitive landscape as well, right? You have to be able to talk about a lot of different topics. You need to be able to connect dots for clients and bring value add in all different asset classes and facets of their life.
Yeah, and Michael, it's also a matter of growing your network as well, right? So, you know, whether it's with more accountants, more attorneys, more estate planners, you know, you have to build your own network.
Yeah, absolutely. What we found is that it's interesting because you think of the traditional model, people come to you for investments, right? And now clients and prospects are becoming, you know, more and more acclimated to the conversation around, okay, well, what else are you doing? Are you doing anything on the estate planning side? How are you thinking about taxes? How are you leveraging technology in your portfolios? I find that the conversations about investments, while they're really important, are the last conversation we're having. We're talking much more about financial planning, structuring the accounts, how we want everything in place. And then we'll get to the investments, and that, you know, you have to do a really good job, but that's almost table stakes at this point.
Yeah, and George, you're seeing multi-generational teams as well.
Yeah, I would agree with David. Teams are getting larger and larger, and in order to compete, you have to be able to add, you have to have a deep bench to go out there and meet people's needs in terms of, you know, there's a lot of behavioral finance that comes with this, right? So it's not just about these table stakes that you're talking about. It's also how do you meet someone in a conversation and relate to them? And you know, clients' families are multi-generational too. So having a bench on your team is really important to meet each need.
Yeah, well, George, let's talk about that in terms of what clients are demanding from advisors, and because it's not a one-size-fits-all solution where you kind of plug them into this model and there you go, especially if you're looking at ultra high net worth or high net worth individuals.
Yeah, so if you're, you know, I would segment our industry in terms of ultra high net worth or high net worth. Everyone sort of has a different definition of that. And then there's the mass affluent piece of it. What we're seeing on the mass affluent piece of the business is that, you know, to improve advisor scale, more institutional model-driven type of portfolios. It helps the advisor. It delivers a better product to the client. On the ultra high net worth and high net worth piece of it, more custom tailored portfolio solutions,
yeah,
alternatives, et cetera, like David.
Right. Well, David, I mean, you need experienced industry professionals for what they're looking for.
Yeah, to me, you know, historically, the average advisor is a generalist or really a salesperson first. And what I think clients are more and more demanding and needing is real expertise. So what we did for our business is we pivoted and said clients care the most about three things: service, financial planning, and investing. And we went out and we hired industry professionals, experienced industry professionals that from those three areas. We have a chief of staff with a management background, we have a professional from Price Waterhouse, and then I'm the investment professional and I have 25 years of investment background. And so we sort of run departments within our team. And that way we ensure we're delivering clients real expertise, not just something we've stamped or we know a little bit about.
You actually mentioned something very specific. I agree with you with those 3 pillars, because at the end of the day, no one controls the markets. We don't know where it's going to be tomorrow or today. We can make a guess based on education, but we really don't know. So what can you control? And that's the client experience. So I 100% agree with those pillars, and I think that the pendulum has swung a little too far actually in a lot of the space, because you had all these brokers and investment focused, and then it swung the other way to very planning focused. And I think they're both completely appropriate and priorities. And the pendulum is starting to, I think, come back towards the middle, which says, I am a holistic planner. I'm thinking about everything in your balance sheet and your liabilities, but I'm also excellent and have expertise on the investment side. So I think the merging of the industries are happening as we speak, and I completely agree with how you're thinking about those priorities.
Yeah, I would agree that the pendulum had swung way too far in the other direction, two extremes, and being able to deliver both is really important. And I think smart clients, smart high net worth families are really looking for that.
Yeah, I was just going to add to that. I think similarly, we have similar type of business where it is siloed, where you have the planning arm, the operations arm, the investment arm, but then having everyone really understand, inch deep and mile wide, and let the experts be, mile deep, inch wide, and really have them work together. Because what we found is that as long as you're dangerous enough to get to the expert, clients are happy, and they really like that experience, because they know that when they pick up the phone and they call Cheryl, who's worked on our operations for 30 years, that they're going to get the answer quickly and it's going to be right. If they have an investment question, they know exactly when and who to get that to. So.
I think the industry is structurally flawed, because every advisor, every small team is required to have scale and do all these things. Small teams can't do everything and do it in a world-class way. You need bigger teams.
Yep.
I think we're all saying the same thing in different ways, and that's great.
Yeah, or you're also seeing growth in outsourcing as well to be able to support those smaller teams. When you were saying the pendulum swung too much to one way, do you mean that investment performance was lagging in a respect because there was so much focus on the other ends of the business?
I think that investment performance may have lagged for certain groups. I don't want a blanket statement,
right.
But I think that I always think of myself, if I'm the client, what do I want? What don't I want? What experience am I looking for? What confidence level am I wanting to feel from the group that's helping me? Right? Again, it goes back to helping versus selling. And I think that a lot of these firms have just gone too far on the planning side and have not allocated the proper resources to the investment side. So there are a lot of people out there that don't need help if you're just going to go buy an index. You just don't need to. Now, there's a lot of behavioral components, as we talked about earlier, and we can argue back and forth about the value there. But from a pure investment in a vacuum, people want esoteric. They want thoughtful. They want thought-provoking. They need and want to be intellectually stimulated. And I joke, but they don't need to be the surgeon in the room, but they need to understand what surgery was being performed.
Yeah, I know advisors who think that the investments are a commodity, and it should be an afterthought. And to any client with an advisor that tells them that, I would say get a new advisor, because investments are not a commodity.
Yeah. How do you see technology helping to grow business to scale?
Look, I feel very lucky we're at Morgan Stanley. We spend a tremendous amount of money on technology. It helps us on the front end with clients, with the website and the clients, how the clients are interacting with us, and it helps us tremendously on the back end, whether we're managing client information or onboarding or facilitating different transactions for clients. Technology is important, and it's getting even more so, especially with the influx of AI, which I don't see as a threat. I see it as a productivity enhancer for all of us. It's going to enable us to do things that we were doing in 5 hours, do them in 1. Efficiency, efficiency, efficiency. It's good for the client and it's good for us.
Right. Well, of course, and Michael, you can think about more intriguing investment ideas and be more creative because you're not going through the mundane task. But you also noted here that technology is a bit fragmented, and that's a challenge for implementing it.
Yeah. So I used to work at Goldman Sachs, right? Great organization, large organization, similar in stature to Morgan Stanley with resources, and those big organizations own a lot of that technology, or it's built in-house. So they talk to each other much better. And there's a reason they don't want to share it with the street either. So on the other side, on the independent side, we have great technology, and we have amazing new technology available all the time. The biggest issue is how they talk to each other, and it becomes very fragmented. So I completely agree that AI is not a threat at all. It's actually a wonderful enhancement to a practice, just like robo-advisors were, because if you think about how we now can automatically rebalance based on thresholds and other things, tax loss harvesting, automating, it allows us as the advisor, it goes back to the commodity versus value add, it allows us to spend more time with the clients, because at the end of the day, why is someone working with me? Why is someone trusting me and my team? It's because I'm sitting there face to face, looking you in the eyes and saying, it's going to be okay, or we're going to solve this problem together. I am here for you and your family. And that can't be replaced by any technology. So the sooner and better we can make everything else efficient in our practice, we can go back to the core of why people are working with us and trust us.
Yeah.
And that's the fun part.
Yeah, I was going to say, I think, we're a 6-person team, but I like to say we operate like a 50-person team based off of the technology that we've put in place. And, different from Morgan Stanley, one of the things I did like about putting the firm together was getting to try all different types of technology, because we know what works best for our clients and the type of clients we work with. So whether it's tax loss harvesting software, whether it's alternative investments, really putting technology and budget towards that to make sure that it works perfectly for the clients that we typically work with, and those 3 or 4 buckets that they tend to fall into.
Yeah, well, it goes back to, it's not a one-size-fits-all solution when it comes to financial planning. I mean, every client has very distinct needs.
Absolutely.
Sure.
Yeah.
It's important. That goes back to my earlier point about having a team that can match each client or each prospective client's needs, right? Being able to address, the grandson's needs or grandfather's needs or grandmother's needs and estate planning, et cetera. You have to be able to meet those needs wherever they're.
I also think for the next gen of advisor too, that this could be a great tool in terms of recruiting, because now you're focused on investing and advising, and there's not as much of that back office work that I think a lot of people feel like they get weighed down, and it's almost like an old person's industry, if you will. But this could really be a tool to attract the next gen of advisor, considering the wealth transfer that's taking place right now.
Yeah. Great point.
I think that there's one misnomer in the industry, which is our job's easy. And I'm confident that everyone at this table and everyone who's in the industry watching will agree. It's really, really difficult. We are operating with vastly different people, even if they have similar investment styles. They are very different people. They have personalities, they have tics, they have wants, they have needs, they have priorities. And it's very difficult. It's a tightrope walk, and I say it every day, so it goes back to the experience. So anything we can do in an industry to give a better experience, whether it's education, automation, whatever it is that comes out, I am all for it, and I'm very supportive of it if it enhances the client experience and allows the advisor to spend more time working with the client hands-on.
Yeah. Well, George, let's talk about portfolio positioning in the current environment, and just on a higher level, because of course every portfolio has different needs. But going into an election and talking about when you have clients that come in and they're concerned about volatility around that, or how they're perceiving inflation and the macro economy in general, how are you thinking about portfolio positioning at a higher level?
So we've been fully invested in our equity portfolio for a long time, and we remain to be. Earlier this year, you saw a brief, not too deep correction. Nasdaq was down about 8% pretty quickly, and the Fed the Fed remains accommodative, right? So we think that going into the election, going into year end, we could see another correction in the range of 5 to 8%, potentially up to 15%, but we think it'll also be a pretty quick correction. We go into, we've been in the higher for longer camp on rates. So with that in mind, we actually don't think we'll get a cut this year. If we do, it'll probably be 1 or 2 25 basis point cuts. And we actually think there's a non-zero chance going into 2025 that the Fed could raise rates. So with that as a backdrop, we ask ourselves, how can we have a market that is going to continue to run? We think we're in a reflationary cycle, not a stagflationary cycle. So you could have growth and you could have higher for longer interest rates. So we're pretty bullish on the S&P 500. That's where we remain to be positioned on equities, on fixed income, because we have that higher for longer narrative or outlook. We've been overweight floating rate fixed income for about a year now. We remain to be overweight there, and that's proven to be a really good trade.
Mm-hmm. And Michael, when you think about it, we came into 2024 expecting 6 to 7 interest rate cuts. We didn't get that, and the market's sitting at all-time highs, right? So it feels as if the way earnings have been digested and how people are perceiving the way corporates have managed their balance sheets in a higher interest rate environment, thinking that it's going to be higher for longer, I think that's almost, it's impressive that it was able to move on the fundamentals versus just what the Fed's going to do.
Absolutely. I mean, I think there's some cracks, right? You think about the names that have really driven the market. It is fairly narrow, right? We've all seen the stats around where those returns are coming from. But I also think that in the environment that we're in with everything that's happening, you can be cautiously optimistic, right? That's the stance we've been taking, and I feel like, you know, as long as you build that diversified portfolio, clients are comfortable with it being a long-term thing. Most of our clients are comfortable with it, and we feel, you know, pretty good staying the course.
Yeah, and Michael, you're looking at fixed income and digital assets, of course, as clients are starting to demand more exposure to that. And small cap growth, I mean, you know, valuations look attractive there as well.
Yeah, we're looking, you know, it's one of these things where I've never been more confused, right? I'm human, I'm not a computer, and I'm confused because on one side, I can see all the problems in the world and the heightened geopolitical risk and all these things have nothing to do with investing that could easily crash the party. And then the party's still raging. And it goes back to my comment about we don't know where the market's going to be tomorrow. So instead of just, you know, saying, okay, stick with the big seven and let it ride, you know, we've been spilling over profits over the last few years. And we've been looking for other areas because we view that the Magnificent Seven are magnificent, but they're turning into utilities when you think about it. They're actually starting to issue dividends. They're becoming more mature companies. So they're going to change their own risk profiles. So where is the biggest opportunity for growth? Where is capital going to flow to find the next Magnificent Seven? And you look at digital assets, you look at small cap growth, international growth, you look areas other than where everyone else is looking, and the answer is they're already there and they're investable. We just don't know who they are and what they are. So to get exposure meaningfully, especially when they haven't participated as much in these broad-based rallies, makes us a lot more comfortable. And then on the fixed income side, with the profits that we're taking from the equities, you know, you could take two approaches. You can either ride the front end of the curve, like you mentioned, on floating rate, which has been a home run. You can own floating rate treasuries, for example, and take literally no risk. Or you can start going out the other way, which is what we're starting to do, and say, look, maybe we're in fall of 2008 in the whole bear market of like long-term interest rates and fixed income, but you're not wrong after a decade cycle if you bought in 08 in the equities. So why not start nibbling at some of these longer dated, massive duration trades and just sit there and kind of just say, okay, well, I may not make the carry I'm making on the short end, but the opportunity cost, I'm not giving it up. I'm actually positioning myself in advance for a rate movement down because I think ultimately we're all in agreement that the odds are the rates will come down versus up over the next, let's call it, decade.
Right. And George, final thoughts here. What is your thoughts around asset allocation? Where are some of the flaws there?
So look, we've spent the last 20 years convincing advisors and clients on the merits of asset allocation. The reality today is asset allocation is a completely flawed concept because it doesn't properly reflect or take into account alternatives. The way we talk to clients, we've stopped using asset allocation. We think about their goals. They have a growth goal and they have an income goal, and it's a spectrum. And then we categorize those investments within those two goals. Look, no one's ever woken up in the morning and said, I need to own a muni bond. They wake up and they say, I need income. Right? And so for us as advisors, what's the best way to get income? One day it might be fixed income, it might be munis or corporate bonds. The next day it might be private credit or infrastructure. Same for growth. We are agnostic to the investment or tool that we're using. We just want the best possible way to satiate those clients' goals at any given time. Asset allocation out, goals-based investing in.
All right, gentlemen, appreciate the insight. Thanks for joining us on Trade Talks, and thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.